You're listening to the MoneyWeb Now podcast series with Simon Brown. Live streamed every weekday at 6:30 a.m.
It's Thursday, 8 June. After pausing, both Canada and Australia raise rates again. I'm Simon Brown, coming at you live and loud from the MoneyWeb global headquarters in Johannesburg, South Africa. On the show today, Demystifying, I want to ask him, where's he finding value on the JSE right now? We certainly had a giant day in retailers. It looked like a foreigner just arrived and said, buy me retailers, all of them, up 4-5% pretty much across the board. John T. Sachs from Geltech talking their recent alternative investment survey showing increasing interest in this asset class. And then Elana van der Berg from Momentum Corporate. Two-part system details are out and set to come into force in 2024. This show is brought to you by Stanlib. Visit stanlib.com to get in touch with one of their investment specialists. Stanlib Asset Management is an authorized financial services provider. Morning headlines for MoneyWeb. Gonongwana rejects Eskom's financial reporting exemption application. He's saying the state-owned power utility needs to be more operationally fit to reduce the scope of fraud and corruption before such an exemption can be considered. Except, of course, it was given and then withdrawn and now considered. Confused. Business Day, Renergen gets $750 million in Phase 2 funding. There's some T's and C's, but this puts them well on course for getting the funding for that second phase. Morning markets, US was red, S&P down 0.4% and Nasdaq off 1.75%. Asia is mixed with Sydney up 0.1% and Tokyo down 0.1%. Commodities mixed all over the place. Gold 1,961. Your green is Brent at 76.82. Platinum 1,027. Palladium 1,392. Rand is 19.10 after dipping below 19 for a short window yesterday. Bitcoin 26,300. 10 cent down 1.5%. Top 40 looking for a red open of 150 points or 0.2% lower.
MoneyWeb Now, on the money. Also available on podcast.
Chatting now with Jimmy Moyaha, independent analyst. Jimmy, appreciate the early morning. I mentioned in the intro that someone, and it looked like foreigners because they were indiscriminate on price, was buying our retailers. And it got me pondering. I mean, there's a lot of quality on the market that is cheap. And it is scary out there right now in SA with inflation and load shedding, albeit reduced, and Russia and all those sort of things. But I mean, there must be some value that you're looking at rather than sort of sticking your head in the sand and hoping it all goes away.
Morning, Simon. You know, the funny thing is, had you asked me this question, I'd say a week, maybe even 2 weeks ago, I would be with my head in the sand. And you and I have had this conversation. I've had this conversation on multiple platforms to say there's a lot of uncertainty that's plaguing SA. And as a result of some of those factors that you mentioned, it's best to sit on things like cash. I mean, yes, inflation is going to have an impact on it and all of that, but you rather have that as an impact rather than some of the volatility that we saw on stocks, right? And I had a look at just a myriad of charts following yesterday's spike on retailers, just to try and see what was happening there. And you were very right to say that it looks as though price doesn't really matter. And it looks as though the market is starting to see that, yes, the top 40 had that big run at the start of the year. We were up 9 or 10% at one stage.
Yeah.
We have come back from there and that sort of thing. But I think what's playing out right now is evidence of the resilience of SA stocks. And it makes me so happy to see, because you look across the board, across the sectors. So it's not retailers was yesterday, but it's not really retailer specific, because you look at the likes of Tungela or any real stock that was on a downward trajectory. And you're starting to see that over the last week, maybe, or in this week in particular, there's been almost a rebound. And for the longest time, we couldn't pick out the bottoms on any of these stocks. And you still can't. But what you're starting to see is maybe the market is saying the SA picture, whilst it's still under pressure, does indeed present value. So where there was a lot of fear and a lot of risk-off sentiment and all of that, the global market had a huge sell-off in SA stocks. And SA stocks had their own problems to contend with. I mean, the likes of Astral Foods saying that they spent 700 million on load shedding costs and that sort of thing. That sent the market spiraling to a certain extent from an international perspective. Investors were saying, but hang on, I mean, if load shedding is this bad, what's going to happen? Are these companies going to collapse? And I think companies just got to a point where they were way too cheap and way too discounted in South Africa, especially relative to the rest of the world. So the month of May was a particularly poor month for our top 40, given that we wiped out almost all of April's gains, right? So that already had put us in an interesting position. And I think at that point, markets were like, but the SA stocks aren't actually bad stocks. They are undervalued at this stage. They are dealing with all sorts of macro and external factors that are beyond most of their control. So company performances that have come out in terms of numbers now, the numbers are strong, but the external factors are beyond their control. There's nothing companies can do about the load shedding situation except adapt to it. And what the international market and international community is seeing is that South Africa's ability to adapt and the ability of our markets and our companies to adapt has proven to be far more resilient than what they had imagined. So where you're seeing that the NASDAQ and the S&P and all of those other markets were having green cycles even during high inflation, we were under pressure, and we've shown the international space that our stocks are actually good value stocks. Our companies perform well. We're used to performing under this level of pressure. And even with something like load shedding, we're still strong in that respect. And I think just to close on that is, if we start to see positive news out of the government and the stakeholders that matter on these things. I mean, yes, the announcement with from Treasury around Eskom, that is considered a positive announcement towards the South African picture, because you're not going to continue bailing them out. Your narrative that you're putting in the market is, we're not going to continue to finance what we've been financing in the past. And investors are in desperate need of that at the moment. And if the government actually does keep giving them that and keep doing things to avoid the concerns that the IMF raised in their 175-page concern of South Africa, then you might actually see that SA stocks are going to do exceptionally well going forward.
Yeah, that little bit of good news gives it a large amount of juicing, because there's just so much negativity out there. Jimmy Moyaha, independent analyst, appreciate the early morning.
Your money knows it's not just about the money. It's about your returns returning the favor and empowering people. Your money can do more to change the narrative. Beyond delivering consistent returns, investing in the Stanlib Khanyisa Impact Investment Fund can help eradicate poverty and protect the environment. Invest for more impact at stanlib.com/more. Stanlib Asset Management is an authorized financial services provider.
MoneyWeb now, on the money.
Chatting with John T. Sachs, partner at Geltech. The first Geltech Alternatives Investment Survey just released. John T., appreciate the time today. What stood out for me, actually a lot of things stood out for me, but I think top of it, 64% of individual investors invest in alternative investments. If we had gone back a decade, it probably was 6.4%. I mean, there really has been a huge growth in alternative investments over the last number of years.
Yeah, Simon, there has been, the survey, was a sample from 1,300 participants. So we really have rich data. And I think to deal with your point is alternative investing is becoming more mainstream. There are more fund managers in the market that are giving investors access to unlisted investments, to really more high risk type of alternatives. And I think the market needs it, and the market has really been latching it up. But something which I'd love to discuss in a bit more detail is information behind it or around it is one of the biggest hindrance into people actually investing. They don't know who to invest with, what information to receive. And one of the reasons for lack of investment is also around financial advisors who either aren't familiar with the product, don't have a license for the product, or the company or practice they're in haven't approved alternatives. So there is still significant potential of growth in this market. but there's a lot of education that is needed.
I take your point on that. I mean, absolutely. I mean, again, a decade ago, it was really 12J. Yes, there was a bit of private equity, but that wasn't for the average person in the street much at all. And I mean, in looking at allocation, it seems to be around 1 to 10% of portfolios. That's where the majority, 69% of investors are allocating. And to me, that does seem small. And it takes to your point around caution. And I appreciate if you're saying that, some parts of alternatives, crypto, sure, keep it small. But other parts of alternatives aren't necessarily a higher risk environment at all.
I agree. If you look at the hedge fund market, depending on the manager, you're ultimately getting equity exposure, but potentially the risk profile isn't really high. So investors should be potentially allocating more. Structured products is a great example. There are many structured products in the market where you get exposure to US businesses, but have capital protection if the markets does a nosedive. So we classify alternatives as risky, but they're not necessarily are, especially where there's capital protection. So my expectation is over time, people's allocation will increase as they become more educated in these products. But what we really do need, and we're seeing it, is growth in the advisor space.
Yeah.
Because advisors understand their clients and they understand investing. And one of the things that stood out for me the most is if you look at the reasons why people invest in alternatives, individuals, they want higher returns, which makes sense. They're emotional, they want to be wealthy. But the same question posed to financial advisors, over 90% indicated that higher returns isn't something that they even consider with these investments. What they consider important is diversification and that it's uncorrelated to traditional markets. And that's the type of thinking investors should actually have. So if advisors were more educated on alternatives, I think we'd see a much larger portion of the market investing because they need that sounding board, and we'd see much quicker growth in this space. But I think we're moving in the right direction for sure.
I think we are. And I mean, and to your point, that was exactly what stood out to me is investors want the higher returns. And sure, again, there are sectors within alternative investments. Heck, there's sectors within the JSE where your risk reward is higher. But that's not always the sell there. It is around different asset classes. It's around sort of diversification, uncorrelated. One of the things I really like about alternatives is that often they are unlisted. So I don't get that minute by minute sort of, you're making money or you're losing money type of volatility.
Yeah, one would need to point to the crypto market, So our business is in that space. And what we see is when the markets crash, we get lots of investors. When the market goes up, we get lots of investors. And in between, we get people who are making knee-jerk reactions. And it's an emotional game for investors who aren't going through financial advisors. They're managing their own money. So to your point, I can't agree with you more. If investors would just take their eye off returns, the numbers on a daily basis, they'd probably be invested for longer and experience much higher returns, because as time goes, potentially your returns will do better if you stick to it. But yeah, this is an emotional game for many.
It absolutely is. I want to end off on advisors. You talk around the important role that they play. They know their clients. They can sort of talk us off the ledge when we're getting scared or nervous or something like that. I mean, I'm assuming that's a big part of growing this industry. Product is important, but speaking to advisors and getting them on board and understanding where and how alternatives fit.
Definitely. What we've experienced, it's all about education. If you can really articulate and explain an investment to an advisor, they can get their head around it, and then they can decide which clients to take this to. Yeah. So, alternatives is not for everyone. If you are very senior in age and you've got enough capital to see you through, I personally think you shouldn't be considering alternatives. If you're younger, definitely. You can take a bit more risk. The return potential could have a significant impact on your future. We're losing, 1 to 3% of your portfolio based on an investment that goes south when you're young. That's fine. That's the nature of investing. That's the nature of the risk you can take being young. But education is key. And what we're seeing from the survey is people who aren't investing, over 50% said the reason they haven't invested is because they don't know where to access information on alternative investments. And, those are the type of people that should be engaging a financial advisor, learning what options there are in the market, seeing what's right for their portfolio and investing or not.
Yeah, and making those informed decisions. And I take your point. It's the unknown, and then they stay away. John T. Sachs, partner, Jotech, appreciate the time. And that's our poll today on LinkedIn and Twitter. Are you invested into any alternative assets, which is broadcloth? I mean, it includes crypto as well, I suppose. Have your vote, have your say, LinkedIn and Twitter.
Your money gives a damn. If it could protest and sign petitions, your money would. But your money can do more than that. When you invest in Stanlib's Infrastructure Investment Fund, beyond getting solid returns, you are helping to build a more sustainable future through job creation and positive economic growth. Damn right you are. Invest for more impact at stanlib.com/more. Stanlib Asset Management is an authorized financial services provider.
MoneyWeb now. On the money.
I'm chatting with Elana van der Berg, legal and technical manager at Momentum Corporate. Elana, appreciate the time. Two-pot system, retirement system, will be effective from 1st of March next year. It's taken a while to get to this point. I suppose the key point is, drawbacks and opportunities. I suppose drawback is you're taking from your retirement, which is never good. Opportunity is that if it's really tough, maybe it's not the worst thing in the world.
Yeah, so thanks, Simon. Thanks for having me. So for me, the most obvious opportunity, like you just stated, is that going forward under the two-pot, members of all funds. So it's not only your employer funds, but also if you're a member of a preservation fund or a retirement annuity fund, you will now be able to get money from your retirement fund at any time once a year. So if I'm a member of an employer fund, it means if I'm in financial need, no need for me to resign and run the risk of not getting another job. I can now access my retirement savings anytime, once a year. Same for retirement annuity fund member. No need for me to wait until I reach 55 years to be able to take a portion. I can now access it anytime, once a year. Same for a preservation fund member. As you know, at the moment, once you're in a preservation fund, you can take that once-off cash withdrawal. But once two-pot is implemented, it means also for a preservation fund member, you can now, going forward, take a portion of your retirement savings once a year at any time. But this is, of course, provided that you actually have a savings spot in the preservation fund. So having said this, so this is the one opportunity.
Yeah.
To touch on the other opportunity, and I think this second opportunity is maybe why we as the industry is in full support of the two-pot system. What we hope, and this is the opportunity that we see, is that once two-pot is implemented and it runs smoothly for a couple of years, it will actually mean, and the intention and the impact is that members will be able to retire more comfortably. Reason why we believe this is under the two-pot, once you resign, you will not be able to take the money in your retirement pot. And remember, the money sitting there in your retirement pot will be the bulk of your contributions. It will be the 2/3. So you won't be able to take the bulk of your contributions anymore. And even once you reach retirement, you're still not able to take any of the money in your retirement pot as cash. You will be forced to take that full amount sitting there as a pension, except, of course, if that amount is less than the de minimis. So that's the second opportunity that we see, and very, very positive about that opportunity.
What about the folks who have existing? I mean, I've got Reg 28 funds that obviously I've been investing over the many decades. Does some of that get seeded into the two-pot, or is this only new money post 1 March?
Yeah, so at the moment, Simon, in terms of the current draft bill that we've seen, no seeding was provided, but in all our engagements with National Treasury, and I mean, they've confirmed this on various public forums, seeding will definitely happen, and this the way it's going to happen, the mechanism and the amount, that we'll see in the second draft bill. But it seems as if the way it's going to work is you will be able to transfer a portion of your benefit sitting there as at 1 March 2024 into your savings spot. I know that COSATU wants it to be 1/3. When we had our discussions with National Treasury, they seem they seem to be on the page that it will be 10% of your benefit as at 1 March 2024, capped at an amount of 25,000.
No, I mean, that actually makes some sense, because if suddenly everything got seeded, then it could create some issues. I mean, this has been, as I said up front, it's been a long road to get to this point. But it really does feel, chatting with you and what we've seen so far, is that Treasury's really actually found a really, really good solution here to what's been I don't want to say a problem, but certainly, I mean, you mentioned people resigning to access monies. I mean, this is a really elegant, really good solution.
Yeah, no, I agree. And I think the two issues are actually a little bit at odds with one another. If you think I need money now, I'm in financial dire need, I don't have money to pay off my bond, I'm going to lose my house, but I'm sitting with this pot of money in my retirement fund, and I know, being a educated and well-informed member, I know that money is actually supposed to be for long-term savings. So, it's a difficult decision, and I think all of us are going to struggle with this coming 1 March 2024, because it's going to be a little bit of a temptation having this money in your savings spot. But if I just think of government's initial remarks that they want members to actually only use the money in their savings spot for an emergency. Yeah. But when we saw the first draft, there was no specification, no limitation to say you can only use it for an emergency. So I would say, if I need to give a message to members, I would say, do not use the money in your savings pot as a first port of call. Always use it as a last resort. Don't use it to fund luxuries like a holiday. Don't use it to fund short-term debt. Always remember, it's long-term savings. But as I said, a difficult balance if you're in financial dire need, difficult decision then to make, to use it now or to think it's long-term savings. Yeah, but don't dip into it for luxuries, please. Yeah, don't do that.
No holidays, no dinners out. But I like your point. This really will work, because sometimes it is dire needs, and now there is that extra stopgap. We'll leave it there.
Exactly.
That's Elana van der Berg, a legal and technical manager at Momentum Corporate. Appreciate the time. That's it for today. Chatting with Carl Gevers yesterday around those British American tobacco, the trading update. Slow and steady, I suppose, is it? Unspectacular, but nice defensive, nice sterling dividend. We asked if this is a defensive stock in your portfolio. Almost half said no, you don't do smoking stocks. Fair enough. Over a third said yes, loving those dividends. The rest say no, it is boring. Have your vote, have your say, LinkedIn and Twitter. This show is brought to you by Stanlib. Visit stanlib.com to get in touch with one of their investment specialists. Stanlib Asset Management is an authorized financial services provider. We're live every weekday morning, the MoneyWeb website and the app, 6:30 a.m., podcast just after 7. Thanks to my team, Eddie, Nobochle, Nicole, to you for listening, my guests for their time. My name is Simon Brown. This is MoneyWeb Now. We'll chat again tomorrow. Current state of market returns.
You've been listening to another MoneyWeb Now podcast, posted every weekday at 7 a.m. on moneyweb.co.za. MoneyWeb Now, on the money.